Okay, so we really just want to kind of do a bit of a reminder here about what the perpetual inventory system is doing. Okay, so remember, perpetual just means continuous, always, never stops, in perpetuity, all of that good stuff, right? So it maintains a continual record of the inventory that is purchased and sold. Now remember, we when we complete a purchase using inventory, using the perpetual inventory system, we increase the inventory account directly. And then you're either going to increase cash or you're going to increase accounts payable, depending on how you paid for it. Okay. So when you sell the inventory, you make two entries, just like we did with in chapter 3, right? The original entry is going to be to increase the asset and increase sales revenue, right? So the asset's either going to be cash or it's going to be AR, depending on what or how you sold that particular inventory, okay? The second part of that transaction is going to be the expense part. So we're going to increase cost of goods sold and we're going to decrease inventory. We're increasing cost of goods sold because it's an expense, and we're decreasing inventory because we no longer have that inventory on our shelves to sell, okay? So the periodic inventory system, just some very basic facts here about a periodic inventory system. These are things that I would take down as notes, okay? The point 2 and point 3 here are pretty important, okay? Any returns, any allowances, we record those in a temporary account. Purchase returns and allowances. Okay, this is going to be important as we move forward on this. Any discounts, same thing, they're recorded in a completely separate temporary account, purchase discounts. Now, remember from chapter 3, when we talk about temporary accounts, it means these are accounts that we are going to close at some point in the future. Okay. We don't actually, this is for periodic, not perpetual. So make note of that. Okay. For cost of goods sold, we don't actually record it until after we do a physical inventory count, okay? Not until we do a physical inventory count. These are helpful if we're wanting to track, using a periodic system is helpful if you want to track how many discounts, allowances, returns you took during the period, okay? So let's take a look at a periodic example. This is going to be us purchasing a piece of inventory, okay? So let's assume that Apple, we all know what Apple is. Let's assume that Apple accounts for their direct materials used in manufacturing, something like glue. They account for it using the periodic method, right? So they're going to do a physical inventory count every month or whatever the case is. So let's say Apple purchases $500 of glue on account. So instead of adding this directly to the glue inventory account, right, we're not going to increase inventory directly. We're going to put this in this temporary purchases asset account. This is one of those special account types that we talked about in the first video, okay? We're going to put this in the purchase asset account, okay? And the accounts payable liability is also increased because we bought it on account, okay? So let's take a look at some purchase returns and allowances using the periodic system. Okay, so purchase returns, like we talked about in a previous chapter, those are going to be when a customer returns a good to the seller for any reason. Doesn't matter what the reason is. We're not concerned about why they returned it, at least not at this point. We just need to know that they returned it and they get a full discount or a full amount returned to them, right? 100% discount, full return amount. Okay. So purchase allowances are very similar to returns, except instead of returning the good to the seller, they're going to keep the good and they're going to get a percentage discount, a percentage allowance of the sale price. So I always use the example that, let's say I buy an iPhone, I buy a red one, they send me a black one, I'm not happy about it, and they tell me, well, we're out of stock of the red, so if you'll keep the black iPhone, we will just give you a $200 credit. That is an allowance, okay? So now let's assume that the glue that Apple ordered was not in stock, okay? So if the vendor offered to give Apple a 20% allowance on the $500 purchase, okay? 20% allowance would need to be recorded in that purchase returns and allowances account. This increases it. This is that temporary account that we talked about. It's called purchase returns and allowances. We would also need to record this in the accounts payable liability. We need to reduce that liability because we no longer owe that 20%, right? We're not going to have to pay that. So the calculation simply the purchase price times the allowance percentage, right? So $500 times 20% is $100. So we're going to debit accounts payable to decrease it. We're going to credit purchase returns and allowances to increase it, okay? So we have two different methods that we can use when we are pricing things out. The first is the gross and net price method, okay? Or they're called the gross and net price methods, okay? This is the second inventory that you need to make a decision on. At what price do we record inventory? Okay, so the cost of an inventory purchase is the sales price, so let's say it's $10,000, plus any additional cost to prepare the inventory for sale. So that would be like freight in, those shipping costs, insurance costs, that kind of thing. So total, we can see that that inventory actually cost us $10,500, okay? Now, we recall that some vendors will offer us discounts, that 210 net 30, right? If you need to review that, that's back in chapter 3, chapters 3 and 4, I believe. So this is that, or excuse me, not chapter 3 for us. It would have been chapter 7 for us. But this is that 210 net 30, 2% discount if paid within 10 days, the full amount if paid in 30. Okay. So this is where the decision actually comes in. How do we want to record those purchases? Well, if we recorded it the gross method, we're going to record it assuming that we're not going to be taking the discount. And we will only record the discount if we actually take it. So this is, we would record this at the full $10,500. Okay. The net method, we're making the assumption that we will take the discount. Okay. So we account for it as though the discount's already been taken, and we record the inventory at the minimum price. The minimum price is that 2% discount in this instance. Okay. So we will walk through an example of each of these in the next video. If you have any questions, please feel free to contact me.